Hello, and welcome to EPK Capital's Daily Market Briefing, where we simplify investment and wealth management so you can build wealth for generations. If the market felt like it was flying blind over the last 24 hours, it's because, in many ways, it is. The main story today is not new data, but a lack of it, and alarming private numbers filling the void. We are now in the 36th day of a record-breaking U.S. government shutdown, delaying official economic reports, including today's jobs report. Investors are forced to rely on private data, and what that data showed yesterday sent a chill through the market. Today, we'll cover the market's reaction, dive into shocking layoff numbers at recession-like levels, check on dovish signals from the Bank of England, and see why crypto is at a make-or-break inflection point. Let's get right to the numbers. Since the official U.S. jobs report was postponed, markets traded yesterday with a clear risk-off sentiment, led by a sharp drop in the tech sector. As of the market close on Thursday, November 6th, the S&P 500 fell 1.1%. The Dow Jones Industrial Average dropped 0.8%, and the Nasdaq Composite was the biggest loser, tumbling 1.9% as worries about high AI valuations resurfaced. Now, looking at today's session, Friday, November 7th, U.S. futures are attempting a mild rebound, with the S&P 500 and Nasdaq 100 futures both up around 0.2% in pre-market trading. In Europe, the Stoxx 600 is trading nearly flat, while the UK's FTSE 100 is down about 0.2%. Asia had a weaker session overnight, with the MSCI Asia Pacific Index falling 0.9%. So, why the heavy selling yesterday, and why the anxiety today? It all comes down to one thing: the labor market. The biggest macro event, by far, is the data we're getting on the U.S. job market. With the government shutdown preventing the release of the official non-farm payrolls report, all eyes turn to the private Challenger, Gray and Christmas report on job cuts, released on Thursday. The numbers were staggering. U.S. employers announced 153,074 job cuts in October. This is the highest total for the month of October since 2003. To put that in perspective, this number represents a 183% increase from the job cuts announced in September. This isn't just a one-month blip. The report shows that U.S. employers have announced 1.1 million layoffs so far this year. This is the highest year-to-date total since the 2020 pandemic and is on par with the recession-like levels we saw in 2008 and 2009. So what is driving this surge in layoffs? The Challenger report cites AI adoption, softening demand, and industry correction. Companies are increasingly leaning on artificial intelligence to replace human workers. Both consumer and corporate spending are cooling, leading to belt tightening. Some sectors, particularly warehousing and tech, are correcting after a massive hiring boom during the pandemic. This data was backed up by another private report from ADP, which showed private employers added only 42,000 jobs in October, with significant losses in white-collar industries. The market reaction was logical. This is the first hard data suggesting the soft landing narrative might be in jeopardy. The tech-heavy Nasdaq was hit hardest as investors second-guessed the sky-high valuations of companies benefiting from the AI boom. We saw this reflected in major tech names. Palantir fell 6.8%, Nvidia dropped 3.7%, and Amazon was down 2.9%. In fixed income, the 10-year U.S. Treasury yield fell sharply to 4.09% as investors fled to the safety of bonds and priced in a weaker economy. The jobs data was the main event, but not the only one. The political elephant in the room remains the U.S. government shutdown. Now in its 36th day, it's the longest in history. This is the primary reason investors are flying blind, as we have no official data on inflation or employment. This uncertainty is, in itself, a drag on the market. Across the Atlantic, we received a major update from the Bank of England. In the minutes from their November 5th meeting, the Monetary Policy Committee signaled a clear, dovish tilt. While balancing risks, they noted that progress on disinflation has continued. The key phrase from their summary was that if this progress continues, the bank rate is likely to continue on a gradual downward path. This confirms that the UK's central bank is in rate-cutting mode, adding to the global slowing growth narrative and helping to pull bond yields lower. This also weighed on the US dollar, which weakened 0.5% against a basket of currencies. Finally, let's turn to the crypto world, where the narrative has turned from bullish to make or break. Bitcoin is currently trading around $101,700 after a volatile week that saw it briefly dip below the psychological $100,000 support level on Tuesday. Ethereum is also under pressure, trading around $3,348. The strong autumn rally we saw in crypto is clearly stalling. According to market analysts, this is due to weak technical conditions and declining investor interest in the U.S. spot Bitcoin ETFs. Those inflows, which were a major catalyst, are reportedly drying up. This has put the market on edge. Analysts are now drawing nervous comparisons to November 2021, when a similar setup preceded a major market crash. Bitcoin is currently testing a critical multi-year uptrend support zone. If it fails to hold key levels, specifically $100,000 and $94,000, we could see a much deeper correction. However, if it finds support here and rebounds, it could be the new base for a push to all-time highs. It is a true make-or-break moment for the crypto space. So, to recap the last 24 hours, the market is being rattled by a severe spike in U.S. layoffs, with private data showing recession-like levels of job cuts. This bad news was amplified by the U.S. government shutdown preventing official data, forcing investors to guess in the dark. This fear sent the Nasdaq tumbling and pulled bond yields down. Globally, the Bank of England has confirmed its dovish, rate-cutting stance. And in the crypto market, the autumn rally is on life support, testing critical levels as ETF inflows reportedly slow down. Looking ahead to next week, the market will remain obsessed with any and all data related to the economy, especially employment. And, of course, any news on a potential resolution to the shutdown. This is your AI market analyst. Thank you for watching.